Cameron Dawson of NewEdge is here now as well. We'll turn to her first. So what's the story?
Well, the statement was hawkish. The dots were hawkish. The SEP was hawkish. But then there was that little window in the press conference where Powell wasn't necessarily the most hawkish he's ever been. He didn't play the hawkish greatest hits. Instead, he talked about how, yes, July is a live meeting, but certainly wasn't committing to it. And you certainly saw the market sort of take that with the interest rates kind of coming off of their highs for the day, stocks rebounding. But I think the reality here is that the Fed still sees a lot more work to be done and that their job-fighting inflation simply is not done yet.
You're keying off what some have been talking about, that he went out of his way, some are suggesting, to say July isn't predetermined.
Yeah.
And at that moment, maybe the stock market took some comfort in that, but it may be short-lived. We'll just have to watch and see.
It certainly seems that way. It's interesting to have so much unanimity about the need for more hikes and yet say that July wasn't necessarily going to be an absolute. Now, they always talk about wanting to remain very data dependent, so that's very par for the course. But the fact is they're still guiding for effectively 2 more hikes this year to get to that 5.6% median rate.
Yep. Let's bring in Jeffrey Gundlach right now. He's the CEO, CIO, and co-founder of DoubleLine Capital, with us as always on this Fed Day. Jeffrey, it's good to see you. Steve Leisman, as I said at the outset here, described this as very hawkish. Rick Santelli said hawkish times 10. What was your take?
It was definitely hawkish in the rhetoric, but obviously wasn't hawkish in the action. It's the pause. I feel like the Fed is getting kind of Mr. Magoo-like again, where the last meeting it was a hike, but it was called a dovish hike. And now we've got a hawkish pause. I wonder what the mix will be in the July meeting, because it seems like the unanimity of opinion that we need more rate hikes has been made clear, but the path of rate hikes is all over the place. I'd like to remind people that the Fed has had a bad record of forecasting where the Fed funds rate is going to be, and Jay Powell, to his credit, pointed that out at the end of his press conference. It's interesting to notice that 2 years ago, the forecast for the Fed funds rate at the end of 2023 was 50 to 75 basis points was the median dot plot. So they missed by 450 basis points, and even more if they continue to hike, which I don't think they're going to do. So we seem to have some Fed people thinking that rates are going to stay above 5 for years, and some other Fed people think it's going down to 2.5. So as of a couple meetings ago, Jay seemed to have the ducks all in a row. Everybody was in agreement, and now it's like he's trying to herd cats again, and he's doing the best he can. But I don't understand all of this talk about this strong economy. There are so many indicators that are deeply in recessionary territory, and people talk about the strength of the labor market, and there's been many months of beats on that. But the most recent labor market report, which was touted as being very strong, was not strong. There was a growth in jobs, but there was a significant decrease in average hours worked. And if you take the product of those two, number of jobs times average hours worked, you kind of get economic aggregate output. And yes, jobs went up, but the hours worked fell enough that if hours worked had stayed the same, the product of jobs times hours worked, to get to the product that we're at, you would have actually had a loss of jobs. If hours worked had stayed stable, to get this amount of output, you would have had more than 100,000 jobs lost. So that's not really that strong. And I don't really understand why the Fed is kind of making the same, I think, mistake that they made a year and a half ago, but in reverse. They're not looking at the high-frequency data. There was a lot of quick commentary after the statement, which was a hawkish statement. And I think Steve Leisman did a nice graphic where he acted like he was driving a car but looking backwards. I think that's a riff on my Mr. Magoo theme, and I agree that that's what's happening here. If you look at real economic indicators that are more high frequency, they're really bad. I mean, M2 is negative at a level year over year that hasn't been seen in decades. Leading indicators are negative 8% over the last 6 months annualized and the last year. The yield curve has been inverted for a long time and is inverted by 100 basis points further 2/10 over the past year. ISM, new orders, are in deeply recessionary territory. ISM manufacturing PMI is massively recessionary, and even services has given up the ghost, going down to 50.3. on the services ISM PMI. I'm really hard-pressed to find an indicator that's really strong, and you can tell me it's employment, but the thing that I just referenced about the aggregate product, but also the unemployment rate has peaked its head above its 12-month moving average. Not by a lot, but it's above its 12-month moving average. Now, it's not anywhere close to its 36-month moving average, which is an absolute lead pipe cinch. If it crosses that, you're in a recession. That's still up at about 5%. But when you think of the 36-month moving average, that's 3 years. So 3 years ago, we're talking about the depths of the pandemic, and unemployment just fell off, spiked tremendously, and now has come back down. So that's going to be falling precipitously. So I don't think the Fed's going to hike again. I think we've got a trend in place here, Scott. It went 25, then 50, then 75 for a while, then 50, then 25, then 0. I don't know. Maybe I'm just a mathematician or something, but I see a trend here. And I don't think the Fed's going to be raising interest rates again. I tweeted that out right after the last meeting. One thing about this, and then I'll stop and you can probe further. One thing about this is one of the most easy to predict Fed meetings of all time. I almost feel like we're back 4 years ago when every meeting you knew they weren't going to raise rates. I think it was universally believed that this would be a pause and that this would be a hawkish statement to try to offset the complication of having financial stress with conditions tightening and 3 bank failures while inflation is still somewhat sticky.